Welcome to the Pro Ticker Deep Dive.
Glad to be here.
So I want you to take a second and just imagine a world where the line between your traditional everyday checking account and your digital crypto wallet just vanishes.
Poof, gone.
Exactly. I mean, completely evaporates. What if moving millions of dollars in fiat currency, say, to buy a massive block of Bitcoin or settle some complex smart contract was as instantaneous, as frictionless, and as unalterably final as handing someone a physical $20 bill on the street?
Right, which is wild to think about.
It is. No 3-day waiting periods, no intermediary holding your funds in escrow, no wire transfer fees slowly eating away at your capital, just an immediate, seamless exchange of value.
It's a genuinely staggering premise.
Yeah.
Mostly because it fundamentally challenges the basic physics of how we've been told money has to move in a modern economy.
Yeah.
If you look back over the last decade or so, we have essentially operated in a global system where traditional fiat finance and digital assets lived in two entirely separate universes.
Completely walled off from each other.
Walled off by this massive, almost impenetrable moat of regulatory red tape, legacy technology, and just intense risk management protocols. But what we are looking at today is the moment that moat was finally officially bridged.
And that bridge is exactly what we are here to explore. We are going into the mechanics of a truly historic, monumental shift in the global financial system that occurred on March 4th, 2026.
A huge day.
Massive. Kraken Financial, a name anyone in the digital asset space knows well, has just become the very first digital asset bank in United States history to be granted a Federal Reserve Master account.
Which is...
Yeah, if you've been paying attention to the financial space at all, you probably saw the headlines and knew it was a big deal. But today, we are going to look under the hood and figure out the mechanics of why this changes the game forever.
The magnitude of this really can't be overstated. We aren't talking about a software update here.
No.
We aren't talking about a new feature on a trading app. This is a fundamental structural rewiring of the plumbing of the United States dollar.
The core plumbing.
The core plumbing. By gaining direct, unmediated access to the Federal Reserve's core payment infrastructure, Kraken is effectively bypassing the traditional commercial bank gatekeepers that have controlled the flow of institutional money for over a century.
Wow.
So for you, the listener, whether you are a seasoned institutional investor managing a multi-billion-dollar fund or just someone who is insanely curious about the future of money, this development redefines what a bank actually is in the 21st century.
Okay, let's unpack this. Because to really grasp the gravity of that March 4th announcement, we need to unlock what is essentially the ultimate VIP room of global finance, which is the master account.
The golden ticket.
Right. What exactly is a Federal Reserve master account, and why is every single financial institution on Earth willing to spend years and millions of dollars just for the chance to get one?
Well, the easiest way to conceptualize it is to think of a master account as a bank account for banks.
Okay.
You and I, as retail consumers, we keep our checking and savings accounts at a commercial bank.
Yeah.
But where do those commercial banks keep their money?
They don't just keep it in a giant vault in the back room.
Right, they keep it at the central bank. A master account is an account held directly at one of the 12 regional Federal Reserve banks.
And in Kraken's specific case, where does that sit?
Because of where their charter is based, that account sits at the Federal Reserve Bank of Kansas City.
Got it.
Going all the way back to the establishment of the Federal Reserve System in 1913, these accounts have been the strictly guarded, exclusive domain of heavily regulated depository institutions. Owning one gives you the legal and technical ability to maintain account balances directly on the central bank's ledger.
Which means you get direct access to the Fed's ultimate payment rail, right? Fedwire.
Precisely. Fedwire is the real-time gross settlement platform of the Federal Reserve. It is the invisible, highly secure nervous system of the entire American economy.
We're talking huge volume here.
Unbelievable volume. A system that processes trillions of US dollars in transfers every single business day. When a commercial bank that holds a master account wants to settle a massive transaction with another bank, it doesn't send physical cash, and it doesn't rely on IOUs.
Right.
It executes that transfer directly on the central bank's balance sheet through Fedwire. The settlement is immediate, it is final, and crucially, it carries absolute zero credit risk because the transaction is backed by the full faith and credit of the United States government.
Let's ground this with an analogy, because I know the mechanics of Fedwire can feel pretty abstract. I like to think of it like municipal plumbing. Having a master account is like having a direct, high-pressure, commercial-grade pipe connected straight to the city's main water supply.
That's a great way to look at it.
You turn the tap, the water flows instantly, and you never have to worry about where it's coming from. But the old way, the way crypto firms and digital asset companies have been forced to operate for years because they were locked out of the system, is like having to buy your water in buckets from your neighbor.
That's actually a brilliant way to visualize the friction involved. Because without a master account, a financial institution, no matter how technologically advanced or well-funded they are, is essentially just a static vault.
Right, they can't actually move anything.
Exactly. They have zero independent capacity to move fiat money across the broader financial system.
Yeah.
So what do? They are forced into a state of total dependency.
They have to go to the neighbor.
They have to establish what are known as correspondent banking relationships with traditional commercial banks, the neighbors who do have the direct pipe. The correspondent bank acts as the middleman, taking the crypto firm's instructions and facilitating the fiat transactions on their behalf.
But relying on your neighbor to carry buckets of water back and forth for your business is incredibly inefficient. There's a massive cost to that friction.
There are three distinct compounding costs to that friction. First, you have the literal financial cost. Your neighbor isn't carrying those buckets for free.
Of course not.
They charge intermediary fees for every single transfer, which chips away at your margins. Second, you have the temporal cost latency. The neighbor has their own schedule, their own compliance checks, and their own batch processing windows.
So you're on their timeline.
Entirely.
Mm.
So a transfer that should take milliseconds ends up taking 24 to 48 hours to fully clear and settle in the traditional banking system.
Wait, let me stop you there because I want to make sure we highlight the third cost, which is arguably the most dangerous for these companies, and that is counterparty risk.
Yes, the biggest one.
If you are relying on a correspondent bank, what happens if that bank suddenly changes its risk appetite? What happens if they decide, you know what, dealing with crypto firms is bringing us too much regulatory heat, we're cutting you off?
That is the existential dread that has haunted the digital asset industry from its inception. It's known as de-risking.
De-risking.
We have seen countless historical examples where major crypto exchanges or digital asset platforms suddenly lost access to their traditional banking partners overnight.
Just completely unplugged.
Unplugged. And when that happens, your operations simply grind to a halt. You can't process customer withdrawals. You can't accept deposits. You are paralyzed.
Wow.
So when we talk about Kraken getting this master account, we aren't just talking about saving a few bucks on wire fees or speeding up a transaction. We are talking about systemic inoculation.
Because they have their own pipe now.
Exactly. By securing their own direct pipe to the Fed, Kraken has effectively eliminated the threat of being abruptly excommunicated from the fiat banking system by a skittish third-party commercial bank.
Think about your own life for a second. Think about the last time you were waiting for a significant bank transfer to clear. Maybe you were closing on a house, maybe you're trying to fund a new business account, and you were just sitting there refreshing your screen for 3 days, locked in this stressful limbo, wondering where your money actually is.
It's the worst.
Now, scale that anxiety up to institutional proportions. Multiply that frustration by billions of dollars moving across borders to capture fleeting arbitrage opportunities in the crypto market. That is the exact problem this master account solves. Kraken doesn't have to ask permission from a traditional bank to move money anymore.
And this brings up a crucial piece of the puzzle. The Federal Reserve does not just hand these VIP master account passes out to anyone who asks nicely.
Right. It's not a free-for-all.
Not at all. They are fiercely protective of the Fedwire system, and rightfully so. To understand how Kraken actually managed to breach these walls, we have to look away from Wall Street and Silicon Valley and travel to a place that most people definitely do not associate with cutting-edge experimental financial technology.
We have to talk about Wyoming.
We have to talk about what happened in Wyoming.
Yes. The Wyoming experiment. This is one of the most fascinating legislative pivot stories in modern finance. Wyoming essentially looked at the landscape and decided they were going to systematically tame the digital Wild West.
Wyoming has executed a highly deliberate multi-year economic strategy to brand itself as the Silicon Prairie, or as it's frequently called in legal circles, the Delaware of crypto.
Delaware of crypto, I love that.
Just as Delaware became the default state for corporate registrations due to its highly favorable and predictable corporate laws, Wyoming recognized a massive macroeconomic opportunity. They saw that digital assets were clearly becoming a permanent fixture of the global economy, but they also saw that the existing federal regulatory framework was painfully ill-equipped to handle the nuances of blockchain technology and cryptocurrency custody.
Right, because the traditional banking laws were written for a completely different century. They were designed for physical vaults, paper ledgers, and standard loans. So Wyoming's lawmakers got to work.
They did.
In 2019, they passed two absolutely pivotal pieces of legislation, House Bill 74 and Senate File 125, and these laws birthed a completely novel legal entity. They created the Special Purpose Depository Institution Charter.
In the industry, they pronounce it SPDI, SPDI.
Speedy. And the operational rules governing a Wyoming SPDI are wildly, fundamentally different from the bank you and I use for our checking accounts.
The structural contrast between a traditional bank and an SPDI is basically night and day, and it all comes down to how they handle your deposits.
Let's get into that.
A traditional commercial bank operates on what is known as a fractional reserve model. If you go to your local bank today and deposit $100,000, the bank does not take your money, put it in a designated box with your name on it, and leave it there.
I think a lot of people still assume they do.
They really do, but no.
Hmm.
They keep a very small fraction of your money in reserve to handle daily withdrawal requests, and they lend the vast majority of it out. They use your deposits to fund 30-year mortgages, auto loans, small business credit lines.
Right.
That lending spread is the core engine of how a traditional bank generates profit.
But that model inherently creates risk, right? Because the money isn't actually sitting in the vault.
Hmm.
If every single customer at that bank got spooked by a rumor and showed up on the same Tuesday demanding their money back all at once, the bank literally wouldn't have the cash on hand to pay them.
Exactly. That's a classic bank run.
It's exactly why we had to create the FDIC, the Federal Deposit Insurance Corporation, during the Great Depression, to assure retail depositors that the government would make them whole if their fractional reserve bank collapsed.
Precisely. The entire architecture of traditional banking regulation is designed to manage the risk of lending out customer money. But the Wyoming SPDI throws that entire fractional reserve playbook completely out the window. A Wyoming SPDI is legally mandated to be a fully reserved bank.
Explain what that means in practice, because this is the crux of why the Fed even entertained Kraken's application.
It means that an SPDI is strictly, unequivocally prohibited by law from making fiat loans with customer deposits.
Zero loans.
Zero. They cannot issue mortgages. They cannot issue business loans. Instead, they are required by Wyoming state law to hold 100%, and in some operational cases, even more than 100% of all customer fiat deposits in highly liquid, unencumbered assets or actual physical U.S. cash.
So it actually is in the vault.
Yes. If an institutional client parks $10 million at Kraken Financial, that exact $10 million, or its immediate, highly liquid equivalent like short-term U.S. Treasuries, is sitting right there, safely stored at all times.
That is such a paradigm shift when you really think about it, because they are legally barred from lending your fiat deposits out. The fundamental risk profile of the institution collapses.
Exactly.
They don't even require FDIC insurance. The risk of a traditional bank run is effectively engineered out of existence because the money is literally always there, ready to be withdrawn at a moment's notice. Plus, Wyoming didn't just stop at the full reserve requirement. They added massive capital buffers.
Right, the financial padding.
These SPDIs must have a minimum of $5 million in initial capital just to open their doors, and they have to hold enough unencumbered surplus capital to cover 3 full years of operational expenses.
And that ultra-conservative fortress-like balance sheet is exactly why the Federal Reserve ultimately felt they could justify granting this master account.
It made them comfortable.
Right. When federal regulators look at a traditional bank applying for a master account, they have to run complex stress tests to figure out what happens if the bank's loan portfolio goes bad.
Right.
But when they looked at the Wyoming SPDI model, they saw a depository institution that had completely surgically removed credit risk from its deposit-taking operations. It was the exact structural resilience required to make conservative central bankers comfortable with a crypto-native firm.
I want to frame this for you, the listener, around your own personal concept of risk and trust. If you knew with absolute mathematical certainty that your bank kept every single dollar you deposited safely in a vault, rather than lending it out to strangers to buy houses and cars, how would that change your relationship with that institution?
It changes everything.
It's a completely different philosophy of financial safety. And during the early legal and legislative debates surrounding this Wyoming framework, there was a really helpful analogy that kept popping up in the court documents to explain exactly what an SPDI is built to do. It's known as the hypoco and hypocoin analogy.
Oh, this is a great one. It's a very elegant hypothetical that perfectly illustrates the dual-engine functionality of the SPDI charter.
Lay it out for us.
Imagine a large, innovative tech company. We'll call them Hypoco. Hypoco develops and launches a wildly successful new digital asset, a cryptocurrency they call Hypocoin. Now, Hypoco has a massive treasury of these digital assets, and they need a hyper-secure, legally compliant, regulated environment to store them. Under the Wyoming SPDI charter, a bank like Kraken Financial steps in and provides institutional-grade custody for those digital assets. They hold the cryptographic keys to the hypocoins with the highest levels of cybersecurity, acting as a qualified custodian.
But if they just did that, they'd essentially just be a fancy digital storage locker. The magic of the SPDI is that it marries that digital custody with traditional banking rails.
Precisely. That is the other half of the equation. Simultaneously, because Kraken is a legally chartered depository institution holding a Federal Reserve master account, they can handle all of Hypoco's boring, everyday fiat currency needs.
Mundane stuff.
Exactly. Hypoco has to pay its developers in US dollars. It has to pay its utility bills, its server costs, its legal fees. Kraken can process that payroll, handle the vendor bill pay, and facilitate massive, multi-million-dollar fiat wire transfers to settle capital purchases. The SPDI acts as a seamless, integrated one-stop bridge between the bleeding-edge digital asset ecosystem and the traditional legacy US dollar economy. It solves the friction of moving between those two worlds.
It sounds so incredibly logical and efficient when we lay it out like that. You hear the full reserve model and the SPDI structure, and you think, well, of course the Fed would approve this. It's safer than a regular bank.
You would think so.
But getting to this point on March 4th was anything but a straight line. This was an absolute grueling gauntlet of regulatory friction. Let's look at the timeline. Kraken originally applied for this master account way back in October 2020.
Over 5 years ago.
They spent over 5.5 years dealing with relentless operational scrutiny, constantly engaging with regulators, proving and reproving their model just to get to a yes in 2026. And the reality is, Kraken is the exception here. They aren't the rule. To truly appreciate the magnitude of Kraken's victory, we have to look closely at the incredibly bitter, multi-year legal battle that preceded it. Specifically, the precedent set by another pioneering Wyoming bank Custodia.
You cannot tell the story of Kraken's master account without centering the Custodia Bank case. It is the essential foundational backdrop to this entire regulatory saga.
Who was behind Custodia?
Custodia Bank was founded by Caitlin Long, who is a deeply respected Wall Street veteran and one of the primary architects of Wyoming's digital asset legislation.
Okay.
Custodia was also chartered as a Wyoming SPDI, and they submitted their application for a Federal Reserve master account right around the exact same time Kraken did in the fall of 2020. But Custodia's journey through the Federal Reserve's bureaucracy took a very different and highly adversarial path.
Right. Kraken kept their heads down and worked behind the scenes for 5.5 years. Custodia's application, on the other hand, sat in a state of pending purgatory for 27 months.
Over 2 years.
Over 2 years of waiting, providing documentation, answering questions, only to be officially and formally denied by the Federal Reserve Board in early 2023. The Fed looked at Custodia's business model and essentially concluded your heavy concentration in crypto-related activities and your reliance on novel technologies poses an unacceptable level of risk to the safety and soundness of the broader U.S. payment system. Access denied.
What's fascinating here is where the legal and philosophical debate really exploded. Because Custodia did not just accept that rejection and walk away. They launched a massive lawsuit against the Federal Reserve.
And what was their main argument?
The core of their legal argument rested on a very specific, intense interpretation of the statutory language within the Federal Reserve Act itself. Custodia pointed to a specific clause that states that Federal Reserve services shall be available to all depository institutions.
Shall. The battle of the word shall. It's amazing how billions of dollars and the future of banking can hinge on one word in a century-old law.
It happens all the time in administrative law. Custodia's highly experienced legal team argued that in legal drafting, shall is an absolute mandate. It means must.
Not maybe, must.
Exactly. They argued that if a bank successfully meets the strict legal definition of an eligible depository institution under the law, which, as a state-chartered Wyoming SPDI, Custodia absolutely did, then the Federal Reserve has zero administrative discretion.
So they have to say yes.
In Custodia's view, yes. The Fed was legally obligated to grant the master account, regardless of how they subjectively felt about the bank's crypto-focused business model. They argued the central bank cannot play favorites if the legal criteria are met.
It was a massive high-stakes showdown over who actually holds the keys to the kingdom. Is the Federal Reserve just a giant administrative rubber stamp that has to let anyone into Fedwire as long as they fill out the state charter paperwork correctly? Or are they active, subjective gatekeepers with the authority to build a wall around the payment system?
The judicial system ultimately provided a definitive, binding answer to that question. Fast forward to October 2025, and the 10th Circuit Court of Appeals issued its ruling in case number 248024.
And what did they say?
It was a sweeping victory for the Federal Reserve. The appellate court looked at the Federal Reserve Act and concluded that the plain, holistic language of the relevant statutes absolutely grants the regional Federal Reserve banks the inherent discretionary power to reject master account applications.
So the Fed does have a say.
A huge say. The court explicitly affirmed that the central bank has a fundamental overriding duty to safeguard the macroeconomic stability of the nation's financial system. And if the Fed determines that an applicant, even one that meets the technical definition of a depository institution, presents a high risk of introducing volatility or operational failure into the core payment rails, exercising their discretion to deny that application is a necessary, legally sound part of their mandate.
So the courts made it crystal clear. The Fed is not a rubber stamp. They have total, unquestionable gatekeeping power. And that context is exactly why Kraken's approval just a few months later is so incredibly significant.
Exactly.
The Fed had just won the legal right to say no to any crypto bank they wanted to. Yet they looked at Kraken, put them through the exact same rigorous evaluation, and chose to say yes. Kraken passed the test that Custodia failed.
What's fascinating here is also how the Custodia battle and the broader scrutiny around these master accounts led to a massive shift in transparency.
You want away.
For decades, the process of applying for a master account was basically a black box. The public had no idea who was applying, how long they were waiting, or why they were being rejected. But that changed due to a crucial provision tucked into the 2022 National Defense Authorization Act.
Wait, a defense spending bill changed banking transparency? How does that happen?
It's a classic legislative maneuver. Massive omnibus bills like the NDAA are often used as vehicles to pass unrelated, bipartisan regulatory reforms. Lawmakers inserted a provision into the 2022 NDAA that legally forced the Federal Reserve to create and publish a publicly accessible, constantly updated online database of every single entity that holds, or is currently applying for, a master account.
Which completely blew the doors off that black box. Suddenly, journalists, competitors, and the public could search this database and see exactly who was pending, who had been approved, and who had been outright rejected.
Everyone could see the scorecard.
It forced the central bank to show its work and operate in the light. We could all literally watch Kraken's applications sit there in the pending column for years until the status finally flipped to approved.
It really was unprecedented visibility.
But let's get into the granular details of that approval, because here is where this story gets deeply nuanced. Kraken finally got the golden ticket, yes, but it is absolutely not an all-access, unrestricted VIP pass. They were granted what the financial industry is informally referring to as a skinny account, and they only got it after surviving what is essentially the Tier 3 regulatory gauntlet.
To really understand what a skinny account is, we have to look back at the account access guidelines that the Federal Reserve Board of Governors officially finalized in August of 2022. The Fed was dealing with this massive influx of applications from novel, non-traditional, state-chartered entities like the Wyoming SPDIs. They realized they needed a standardized, predictable framework to evaluate the wildly different risk profiles of these new applicants. So they created a system that divided all master account applicants into 3 distinct tiers of regulatory scrutiny.
Okay, let's break those tiers down. Tier 1 is your standard bread and butter applicant. These are federally insured depository institutions, your local community bank, or a massive global commercial bank.
The safest bets.
Right. The Fed views them as the lowest baseline risk because they are already completely wrapped in federal regulations. They have FDIC insurance, and they have massive compliance departments. So their review process for a master account is relatively streamlined. Tier 2 steps it up a notch.
What falls into Tier 2?
This tier is for institutions that are not federally insured by the FDIC, but are still subject by specific statutes to federal prudential supervision by agencies like the OCC or the Fed itself. They get a much more rigorous intermediate level of review.
And then, at the absolute apex of regulatory friction, you have Tier 3.
Here we go.
This tier is specifically reserved for eligible financial institutions that are not federally insured and are absolutely not subject to comprehensive federal prudential supervision. This tier perfectly, explicitly describes state-chartered SBZIs with novel business models heavily concentrated in digital assets, exactly like Kraken Financial.
The gauntlet.
Tier 3 applications are subjected to the strictest, most intense, exhaustive, and skeptical level of scrutiny that the Federal Reserve can legally apply. Every single line of code, every compliance protocol, and every balance sheet assumption is aggressively stress-tested.
Kraken survived Tier 3. They ran the gauntlet and made it out the other side. But here's where it gets really interesting. The master account they were ultimately handed was heavily customized and severely restricted. Back in October 2025, Federal Reserve Governor Christopher Waller gave a speech where he actually laid out the intellectual foundation for this compromise.
I remember that speech.
Yeah. He proposed this specific concept of payment accounts, or what the industry dubbed skinny master accounts. He basically addressed the elephant in the room. He said, look, we have these highly innovative tech-forward payments and crypto firms. Under the law, they are legally eligible to hold master accounts. They can provide real value in upgrading our payment systems.
Really?
But they have vastly different business models than legacy banks, and frankly, they do not need and should not have access to all the historical perks and subsidies that come with the traditional bank charter.
It is a brilliantly calibrated risk mitigation strategy by the central bank. The Federal Reserve is trying to thread a nearly impossible needle.
How so?
On one hand, they want to encourage technological innovation. They want to bring these novel digital asset activities out of the shadows and inside the regulatory perimeter where they can be monitored. But on the other hand, their supreme mandate is to protect the taxpayer and insulate the broader traditional financial system from the wild, unpredictable volatility inherent in the cryptocurrency markets. They cannot allow crypto contagion to infect the fiat system.
So let's look at the actual anatomy of Kraken's skinny account. What do they get, and what are they explicitly denied? First off, the approval comes with strings attached. They get an initial one-year term. It's essentially a high-stakes probationary period.
Right, like trial run.
The massive win is that they are allowed to directly connect their internal systems to the core payment rails, like Fedwire, to process their fiat transactions independently. That is the holy grail. But to get that access, they are explicitly forcefully cut off from the other major financial benefits that a Tier 1 bank enjoys.
The two most significant restrictions are profound. First, Kraken will absolutely not be allowed to earn any interest on the reserve balances they hold at the Federal Reserve.
Which is huge.
Massive distinction. Traditional commercial banks earn hundreds of millions, sometimes billions of dollars in essentially risk-free yield simply by parking their excess reserves at the Fed overnight. It is a massive source of passive income for legacy banks. Kraken is denied that subsidy. Their reserves will sit there securely, but they will yield absolutely nothing from the central bank.
That's a huge competitive handicap, but it makes sense given they aren't lending. What's the second major restriction?
The second, and arguably more critical restriction from a systemic risk perspective, is that Kraken is completely denied access to the Federal Reserve's emergency lending facilities.
The discount window.
Yes. This is commonly known in the industry as the discount window. To understand why this matters, you have to look at the history of banking. The discount window was created to be the ultimate lender of last resort.
The safety net.
If a traditional fractional reserve bank suddenly faces a massive, unexpected liquidity crisis, say a modern-day digital bank run, and they can't sell their long-term assets fast enough to pay withdrawing depositors, they can go to the Fed's discount window, pledge their assets as collateral, and borrow emergency cash to survive the panic.
But not Kraken.
Kraken has no such safety net. If they face a liquidity crunch, the Fed will not bail them out. They are entirely on their own.
But this is where the genius of the Wyoming SPDI charter comes full circle. Because they are legally required to hold 100% of their customer deposits in liquid fiat at all times, they mathematically do not need the discount window.
Exactly.
They aren't lending the money out in 30-year mortgages, so they never face a maturity mismatch where they don't have the cash on hand. It's a perfectly engineered symbiotic compromise between state law and federal regulation. The Fed grants Kraken the sheer utilitarian function of the payment rails, but completely refuses to extend the financial subsidy of interest payments or the systemic safety net of the discount window.
It represents a profound structural evolution in American banking. This skinny account model allows Kraken to operate as a fully integrated, directly connected financial institution purely for the highly efficient purposes of clearing and settlement.
Right.
But simultaneously, it completely quarantines and isolates the central bank's balance sheet and, by extension, the American taxpayer from the specific, unique financial risks associated with the digital asset sector. It is a firewall built out of regulatory policy.
Which perfectly sets the stage for the most exciting part of this entire discussion. Let's get into the real-world application. Because when you combine Kraken's incredibly advanced high-speed crypto trading infrastructure with this newly granted direct access to Fedwire, you unlock a financial capability that genuinely sounds like science fiction. We need to talk about atomic settlement and the massive market impact this is going to have.
When financial historians look back at this decade, atomic settlement is likely going to be recognized as the single most disruptive technological concept to emerge from the integration of blockchain and traditional finance.
That's a game changer.
To appreciate how revolutionary it is, we have to contrast it with how legacy finance currently operates. In the traditional financial system, settlement is fundamentally asynchronous. It relies on a process fraught with temporal latency.
Give us an example.
For example, if an institutional fund executes a massive trade to buy a block of equities or traditional assets on a Tuesday, the actual underlying fiat currency and the corresponding asset might not fully clear, exchange hands, and finalize settlement until Thursday. That is a 2-day gap.
And a lot can happen in 2 days.
Exactly. During that 48-hour window, both counterparties are exposed to significant settlement risk. What if the buyer goes bankrupt on Wednesday? What if the intermediary clearinghouse experiences a catastrophic computer failure? That temporal latency creates a massive systemic vulnerability.
But atomic settlement completely alters the physics of that trade. It collapses that window to zero.
It does. Atomic settlement refers to the instantaneous, simultaneous, and irrevocable exchange of fiat currency for digital assets. Both legs of the transaction, the delivery of the Bitcoin or the Ethereum, and the simultaneous payment of the millions of US dollars settle in real time at the exact same millisecond.
At the exact same millisecond.
And crucially, it relies on a cryptographic principle that guarantees that both legs of the transaction settle instantly together, or the entire transaction fails and neither leg settles. There is no middle state. There is no scenario where the seller hands over the crypto and then has to sit around nervously waiting for a wire transfer to clear 2 days later while the market price fluctuates wildly.
I honestly just marvel at the mechanics of this. It is literally the digital teleportation of value across two completely different asset classes. And we have to point out that this specific capability is made entirely possible because the Federal Reserve itself just underwent a massive generational technology upgrade.
Yes, the timing is perfect.
In July of 2025, the Fed finally migrated the entire Fedwire system to the ISO 2022 message standard.
That migration was a critical prerequisite for Kraken's operational model. The old Fedwire system relied on incredibly antiquated legacy messaging formats. Sending a wire transfer under the old system was kind of like sending a very brief, highly constrained text message.
Just the bare minimum info.
Right. It could basically just say, send $100 from account A to account B, with very little room for context or complex instructions. But ISO 2022 is a globally adopted, highly structured, data-rich XML messaging standard. It allows for incredible interoperability across international borders and vastly complex technological systems.
To stick with the analogy, if the old system was a basic text message, ISO 2022 is like sending a comprehensive, heavily encrypted digital dossier. It contains the funds, but it also contains the receipts, the automated compliance checks, the routing logic, and the smart contract triggers, all bundled together in one instantaneous transmission.
Exactly. And by legally possessing a master account, Kraken can now plug their cutting-edge crypto trading engine directly into an ISO 2022 compliant Fedwire. They can communicate directly with the traditional fiat financial system in a highly automated, data-rich format natively understood by both sides.
No translation needed.
This completely eliminates the need to route complex settlement instructions through a correspondent bank, which would historically take those instructions, try to translate them into legacy formats, batch them together, and fundamentally delay the settlement process.
Arjun Sethi, the co-chief executive of Payward, which is the massive parent company that owns Kraken, gave an interview that really captured the essence of this transition. He noted that with this master account in hand, Kraken is now empowered to operate not as a peripheral participant in the U.S. banking system, but as a directly connected financial institution.
A huge distinction.
He essentially argued that this isn't just a win for their company, this is exactly what it looks like when experimental crypto infrastructure finally matures and graduates into core foundational financial infrastructure.
And if we contextualize this within the broader market dynamics surrounding Kraken right now, the timing of this Fed approval is nothing short of impeccable. Just prior to securing this master account, Kraken successfully completed a massive $800 million funding round. That capital injection gave them a staggering valuation of $20 billion.
$20 billion.
And if you look at the cap table, they have secured backing from some of the most aggressive, sophisticated institutional heavyweights in global finance, firms like Jane Street, DRW, and Citadel Securities. And all of this is happening as Kraken aggressively gears up for an impending, highly anticipated initial public offering.
And let's be real, firms like Citadel and Jane Street aren't investing hundreds of millions of dollars just because they think crypto is a fun technological experiment. They are absolutely ruthless about capital efficiency, and they see exactly what atomic settlement directly on Fedwire means for their bottom line.
The capital efficiency angle is the entire ballgame for these institutional backers. Think about how a high-frequency trading firm or a massive institutional market maker operates. In the legacy system, because of that T+2 settlement delay we talked about, billions of dollars of their working capital are constantly tied up, effectively stuck in transit, locked in clearinghouses during that 24 to 48-hour settlement window.
And what does that mean for them?
From the perspective of a trading firm, that is dead capital. It generates no yield, and it cannot be deployed to capture new market opportunities.
But by routing their trades through an institution like Kraken that enables atomic settlement, they suddenly free up massive tranches of that previously trapped capital.
Precisely. If settlement is instantaneous, institutional traders can recycle their capital multiple times a day rather than waiting days between trades. They can execute a trade, instantly settle the fiat and the asset, and immediately redeploy that exact same capital into the next opportunity. It fundamentally changes the math of their trading strategies and drastically lowers their overall cost of capital.
It's like upgrading the backbone of global finance from a crumbling dirt road riddled with slow-moving toll booths to a completely frictionless magnetic levitation bullet train. It doesn't just change the speed of the trip, it changes how frequently you can make the trip and how much cargo you can carry.
Very well said.
Now, I want to make sure we introduce a very clear transition here. Because while the crypto industry, the venture capitalists, and the high-frequency traders are enthusiastically popping champagne over Kraken's victory, there is a massive, highly influential sector of the economy that is viewing this development with absolute dread. We need to look at the pushback. Why are traditional commercial banks sounding the alarm so loudly?
It is absolutely crucial that we view this development impartially and examine the arguments from the legacy financial sector. The traditional banking industry is not just complaining about facing new competition. They have raised significant, structurally valid concerns about the macroeconomic dangers of extending direct central bank access to non-traditional tech-first entities.
Right.
Massive, deeply entrenched lobbying organizations like the Bank Policy Institute, the BPI, and the Independent Community Bankers of America, the ICBA, have been fiercely publicly opposed to this move from day one.
Right. And they have been very methodical in their opposition. They haven't just issued vague complaints. They have laid out 4 very specific major categories of risk that they firmly believe these novel SPDI charters introduce into the American financial system. Let's break those down.
This raises an important question. The first major concern they cite is credit risk. Now, we just discussed how an SPDI doesn't make loans, so you might wonder how credit risk applies.
Yeah, if they don't lend, where's the credit risk?
But traditional banks argue that even with a heavily restricted skinny account, there is always a theoretical operational risk that a tech firm could accidentally or maliciously overdraft its master account at the Federal Reserve during a massive, high-speed transaction failure. If that happens, it could leave the central bank, and by extension the American taxpayer, on the hook to cover the shortfall.
Got it. And the second category is settlement risk. Their argument here centers on the underlying technology. They argue that crypto-native firms are inherently massive targets for sophisticated cyber attacks. If a firm like Kraken experiences a catastrophic operational failure, a massive hack, or a glitch in their smart contracts while executing billions of dollars in Fedwire transfers, it could create a cascading bottleneck that disrupts the ability to process traditional transactions, effectively paralyzing a portion of the critical payment rails.
The third risk, and this is arguably the most existential concern for traditional commercial banks, is financial stability risk. The fear here is rooted in deposit flight.
Deposit flight?
Imagine a fully reserved, highly efficient, crypto-friendly bank like Kraken offering instant settlement. The ICBA fears that this will draw massive amounts of institutional deposits away from traditional commercial banks. If large corporations and funds pull their cash out of local community banks in Ohio or Texas and park it all at Kraken to take advantage of atomic settlement, it literally drains the traditional banking system of the foundational deposits it desperately needs to make loans to local businesses, fund mortgages, and drive the mainstream economy.
That is a fascinating systemic concern. It's the fear that the plumbing will work too well and suck all the water out of the traditional reservoirs. And finally, the fourth major risk they cite is BSA, AML, risk compliance with Bank Secrecy Act, and anti-money laundering regulations.
Right.
The traditional banking lobby argues, pointing to historical data, that the cryptocurrency sector is inherently more opaque and susceptible to illicit finance, terrorist financing, and money laundering. They argue that giving a crypto-native firm a direct, unmediated pipe to Fedwire threatens the integrity of the entire U.S. dollar network by potentially creating a fast lane for bad actors.
When you aggregate these four risks, it raises a very profound debate about the historical principles of American banking. For generations, U.S. banking regulation has been guided by a strict mandate to separate banking from commerce.
Separate the two.
The goal has always been to ensure that depository banks don't take on excessive, speculative commercial risk that could threaten the savings of the public. Traditional banks are subjected to agonizingly comprehensive prudential oversight by a web of regulators, the FDIC, the OCC, the Fed. They pay massive premiums into the Deposit Insurance Fund. They maintain armies of compliance officers.
And the legacy banking argument essentially boils down to this. We have played by these incredibly strict, massively expensive rules for decades to keep the financial system safe. Now, you regulators are letting Silicon Valley tech companies completely bypass the traditional safety net, avoid paying into the FDIC insurance fund, and access the core payment rails using these novel state-level loopholes. It is a fundamentally unlevel playing field.
That's their core argument.
It is a massive ideological debate between maintaining a heavily fortified, deeply conservative traditional financial fortress versus throwing open the gates to allow for rapid structural technological innovation. Our role here is simply to unpack the mechanics of their stance, but when you look at the sheer regulatory burden legacy banks carry, you can absolutely see the logic behind why these institutions are pushing back with everything they have. So what does this all mean? We have the technological breakthrough on one side and the fierce systemic resistance from legacy banks on the other. How does this actually resolve?
Let's zoom out and take the macro view. We need to look at the politics, the policy, and the global race for financial dominance.
Yeah.
Because you simply cannot separate Kraken's monumental approval from the broader, highly charged political and economic landscape of early 2026.
If we connect this to the bigger picture, we have to acknowledge the prevailing political winds in Washington right now. The Trump administration has made very explicit, highly publicized pledges to establish the United States as the undisputed crypto capital of the world.
Right.
There is a clear, coordinated, high-level administrative directive pushing federal agencies to embrace digital assets, integrate them safely into the American economic engine, and prevent the industry and its massive capital reserves from fleeing offshore to more friendly jurisdictions like Singapore or Dubai. And we are seeing that executive ambition actively manifesting in the legislative push on Capitol Hill. For example, the Senate Banking Committee has been aggressively pushing comprehensive legislation known as the Clarity Act. This effort is being heavily spearheaded by key Republicans like Senator Tim Scott.
Clarity Act.
The entire stated goal of the Clarity Act is to fundamentally replace the previous administration's model of regulation by enforcement, where crypto firms operated in a gray area and just got sued by the SEC after the fact, with a clear, predictable, statutory framework. The legislation aims to aggressively crack down on illicit finance and money laundering while simultaneously providing legal safe harbors to protect decentralized finance developers and innovators.
The immediate political reaction to the Kraken approval announcement perfectly illustrates how deeply this issue resonates across the political spectrum. Senator Cynthia Lummis of Wyoming, who has arguably been the most relentless, educated advocate for digital assets in Congress, publicly hailed the Kraken approval as a watershed milestone in American financial history.
A watershed milestone.
She went even further, predicting that this approval signals the dawn of a 21st century financial industry where we will rapidly see traditional legacy banks buying up crypto infrastructure companies and, conversely, massive digital asset companies acquiring traditional commercial banks to merge their capabilities.
And on the state level, Wyoming Governor Mark Gordon released a statement noting that this Federal Reserve action totally, unequivocally validates Wyoming's pioneering digital asset laws. Wyoming lawmakers built the SPDI framework. They weathered years of intense skepticism and criticism from federal regulators and legacy bankers who called it a risky loophole, and now the ultimate arbiter, the Federal Reserve, has effectively signed off on their vision by granting this operational account.
Furthermore, from a pure regulatory analysis standpoint, the financial journalist Eleanor Terrett provided a very sharp, nuanced insight into the subtext of this approval. She pointed out that by granting this direct access to Fedwire, the Federal Reserve is impliedly, officially recognizing that Kraken's internal anti-money laundering and sanctions compliance protocols are robust and sufficient.
That's a great point.
The Fed, an incredibly risk-averse institution, would never, under any circumstances, directly connect an institution to Fedwire if they believed it was a gaping vulnerability for illicit finance. Terrett's analysis suggests this approval is a massive, implicit stamp of federal legitimacy on Kraken's internal compliance mechanisms, severely undercutting one of the legacy banking sector's primary arguments.
This is exactly where I want to challenge you, the listener, to really pause and consider how rapidly our fundamental financial norms are shifting beneath our feet. For years, every panel discussion and financial article talked about how the line between crypto and traditional finance was slowly blurring. But with Kraken officially getting a master account and directly plugging their servers into Fedwire to execute atomic settlement, that line isn't just blurring anymore.
No, it's gone.
It has effectively been erased. The crypto infrastructure isn't parallel to the financial system anymore. It is becoming the core financial infrastructure.
It truly is a remarkable historical synthesis. We are witnessing a scenario where highly aggressive, experimental state-level innovation essentially forced a slow-moving federal-level evolution.
Wyoming forced the issue.
They did. Wyoming recognized a gap, created a hyper-conservative legal container, the Full Reserve SPDI, that mitigated the risk so effectively that the Federal Reserve, after 5.5 grueling years of intense operational scrutiny and massive legal battles with other applicants, finally had to acknowledge its viability. They had to open the door, albeit through a highly customized, heavily restricted skinny account.
Let's do a quick recap to pull all these massive threads together. We've traced an incredible multi-year journey today. We started by looking at a daring, unorthodox state legislative charter passed in Wyoming back in 2019 and 2020. We followed the narrative through years of regulatory deep freezes, intermediary friction, and landmark appellate court battles like the Custodia precedent that affirmed the Fed's ultimate gatekeeping power.
A very long road.
And it all culminated on March 4th, 2026, when Kraken Financial achieved what no other digital asset bank in U.S. history has ever done. They successfully secured a Federal Reserve master account.
And by securing that heavily scrutinized Tier 3 skinny account, Kraken has essentially built a permanent technological and regulatory bridge. They willingly traded away the traditional banking subsidies, like earning interest on central bank reserves and having the safety net of the discount window, in order to capture the ultimate prize: direct, unmediated, programmatic access to Fedwire.
The ultimate prize.
This unprecedented access allows them to bring the holy grail of instant atomic settlement to the institutional digital asset space, fundamentally freeing up massive amounts of trapped capital and systematically reducing counterparty risk across the board.
While traditional banking lobbying groups continue to raise incredibly valid, well-reasoned concerns about systemic contagion, deposit flight, and maintaining a level regulatory playing field, the broader macro-political environment in Washington is currently operating full steam ahead on a mandate to cement the United States as the undisputed digital asset powerhouse of the world economy. Which leaves us with a very deep, lingering, almost philosophical question to mull over as we wrap up.
That's the question.
If tech-first, natively digital companies operating with 100% full reserve mandates and these new skinny master accounts can eventually process payments, custody assets, and move institutional money faster, cheaper, and objectively safer than traditional fractional reserve banks, do we eventually reach a tipping point? Does the traditional legacy commercial banking model, where deposit taking and risky lending are smashed together in one institution, actually become completely obsolete for the average institutional investor?
It is perhaps the most profound structural question facing the global economy today. If the utilitarian functions of payment processing and secure custody become entirely decoupled from the business of credit provision and lending, the very definition of what constitutes a bank will have permanently, irreversibly changed.
Exactly. It is definitely something to think about the next time you find yourself staring at a screen, waiting 3 agonizing days for a simple wire transfer to clear. Thank you so much for joining us on this deep dive. Keep asking hard questions, keep challenging the legacy status quo, and always, always stay insanely curious. We will catch you next time.